Well, let me shift to kind of the larger question of allocations just generally, because we had a conversation a few weeks ago about this. I was really interested. You had kind of two frameworks that Vanguard talks about in terms of thinking about the total allocation of a portfolio. And obviously, Vanguard has lots of funds that are allocated funds, the target date retirement funds or model portfolios. So what goes into kind of determining what's a suitable allocation for an investor to hold?
Right. So we start with what's the objective. We do think it's. I'll tell if I can tell you a quick story. I'll tell you a quick story. It's
Yeah.
there's a great line. Jason Zewig of the Wall Street Journal wrote this article. Our former chairman Jack Brennan has put it in a book. It's a great story, so I'll mention it.
Yeah.
But Jason was down in Florida asking everybody, down there, like how their portfolios were doing. And one guy had the best answer of all. He said, "I don't care. I'm living in Boca." Right. My goal was to live in Boca. I'm living in Boca. And so I often think about that with portfolios, right? What's your objective? What are you trying to achieve? How do we build it to achieve that? So let's identify what that is, right? It could be a lot of, we talked earlier, it could be risk return, can be a return target, can be risk thing, whatever. That's one approach. That's the investment side, but there may be life goals as well, or let's be clear about what that is. Then the second element is what preferences do you have in your portfolio? And the biggest one we see lately has been ESG. I'll just, if I can spend a moment on that, right? So what the analysis and the research Vanguard has done would suggest to you that there is no return benefit or detraction from ESG, right, relative to other investments. So it's generally you're economically indifferent, or mathematically, it's probably a better way to say that. But there may be other reasons why you care to do that, right? There may be policy or social or whatever reasons. And so that's a decision you'd have to make, or an overlay you'd want to make to the math component of what we do. And then the third element is what ingredients we think of, like what investments are you willing to utilize? And in that space, we think of there 4 ways to think about it. So one is asset classes. We've been talking here about bonds. That's an example of an asset class. You can do sub-asset classes. So that's in bond land, that's credit and duration, right? So you can tilt your portfolio. You can add active managers, or you can have some sort of forecast which might change your expectations on the underlying assets. So some combination of those elements are what we call the ingredients, and you need to decide which ones of those you're comfortable with using, right? So let's just use active as an example. Active management has some considerations, and we'd say there's conditions that would make that useful or not. You have to be comfortable with those considerations to even consider using it. So each investment has those own elements. So it's really, what's your objective? What preferences do you have? ESG is currently one that's very popular. And then what ingredients are we comfortable using to try and deliver that?
Okay. So one of the conversations, or when we had that conversation, you mentioned kind of the thoughts about 4 different kinds of primary goals, which I thought were really interesting: a return dominant, a risk dominant, an inflation protection, or a volatility control. Right. Could you just describe those a little bit for us? Because I think they're helpful maybe for investors to see themselves, okay, what resonates with them when they think about those things.
Right. So let's start with total return. So total return tends to be I'm trying to maximize units of return per unit of risk. And effectively there's a mathematically optimal place there, but people may have different risk profiles. So you'll come up with a different risk function. That's the typical way people invest. The other way people can invest would be a return target. So I'm trying to achieve, and let me just say, it has to be a reasonable return target, right? It can't be 10% today, but 3%, or I don't know, maybe 4 is pushing it, but there's a target number I'm trying to reach. What is the minimal amount of risk I need to reach that? And then there's risk-focused portfolios. So you mentioned a couple of those, right? One is inflation. So there's typically, or volatility is another one. So often you can think about, do I want an inflation-protected portfolio? Could be a variety of reasons why that. Your business could be very subjected to inflation. You may want to match your liabilities to your assets. The other one could be volatility. Again, you're there's some function you're dealing with. You don't want to live with volatility, so you want to manage that. So often we think of that as a principal protection portfolio as well. I have this amount of money, I don't want to lose it, and I don't want to live with a lot of volatility. So so we think of it as total return as starting point, but then you could focus on one of the two elements. You could focus on risk, or you could focus on return, and that sort of lays out a construct for what am I trying to achieve. And again, I would say this is what we talk about in the financial space, financial solutions. There's also life goals, right? And I think the value of an advisor is helping somebody understand the life goals, matching them to one of these portfolio constructs, and then honestly helping them have the discipline to stay with that plan through the long term. It's sticking with the plan that's going to really reap the rewards over time.
We would totally agree with that. Obviously, I kind of go back to your story. The answer was I'm living in Boca. So if that was really like, hey, the thing that I needed the most, or one of the things primary goals was I wanted to make sure retirement looked like this. And you'd say, okay, so let's not get distracted by other people's measures of what they might think success would be when it's not necessarily yours. It's kind of distracting from the thing that is really going to make kind of life worthwhile for you versus some number on a portfolio return or compared to something else.
Yeah, a succinct way of saying it is comparison is the thief of happiness, right? So somebody's always they've done analysis of happiness. I've spent a lot of time in this space, and one of the things they say is like, we're all fine until we start comparing ourselves, right? So if Larry has a bigger television, it's like suddenly you feel less than. I mean, social media is, I think, sort of a feeder of this problem, right? Now we really have to like think about what do we care about. I'll just mention a plug for a book. Jack Bogle, our founder, who's since passed away, wrote a great book called Enough, which was based on a New Yorker article. It's about what's enough in your life, right? But it's based on a New Yorker article where Kurt Vonnegut's at some hedge fund manager's party in East Hampton. So you can just imagine the glitterati and it's one of these incredible parties and all this. And one of his friends comes up and says, "Can you believe this, right? Kurt, this is just incredible. It's amazing." He goes, and Kurt says, "Yeah, but I have something that this man will never have." And his friend says, "What's that?" He says, "I have enough." Right. So he was happy. Kurt Vonnegut was happy. And this other, doesn't necessarily mean more is better, right? It's like, what makes us happy, and let's go pursue that. And it's hard you were mentioning earlier, it's hard to do that when you have so much information and so much bombarded with so many new things all the time. But sticking with, that's where I go back to the value of advice. Financial advice is all about the discipline of staying to the plan.
Mm-hmm. That's a great story. I think we might just end with that story because it just, I think it really sums up, kind of investing generally. It's like we can get really pulled off into lots of different statistical measures or somebody else's goals, but knowing what our goals are, what is enough for us, what's really going to drive our kind of sense of happiness, peace of mind, those kinds of things. I mean, that's a much better goal set for investment. And the interesting thing about that is, as Vanguard shown for years and years and years, those kinds of investment goals are actually achievable, through investor behavior, through good investment discipline, kind of sticking with the plan over a long period of time. And I know Vanguard would say something like keeping costs low does help along the way as well. And so we certainly appreciate that too, about the way Vanguard, provides investment solutions at a very, very reasonable cost to investors, including investors at Foster Group. So Daniel, thank you so much for joining us today. This has been great. I think I'm sure we could find lots of other things to talk about, and hopefully we'll do that in the future. But for now, again, just thank you very much for joining us, and thank you for people watching today. We're glad to have you joining us with our Financial Perspectives videos. Again, we put these out bi-monthly, and if you're interested in making an appointment with a Foster Group advisor, we'd love to have that conversation at your convenience. So Daniel, thanks again for joining us. Be well, and we'll see you all soon.
Thanks, Ken.